Okay, good to be back. Great to be discussing this paper, a very nice paper that tackles a hard problem. So let me see if I can get this to, there we go. All right, so most of our models tend to treat leverage as a one-dimensional variable, right? How levered is the firm? If we look at actual corporate capital structure, it tends to have a pretty rich and nuanced structure attached to it. And this dynamic choice of the mix of debt maturity is, I would say, largely unexplored in the literature. And that's what this paper tries to tackle. And it delivers an analytically tractable dynamic equilibrium model of capital structure that allows for both long and short-term debt, and helps us to think about when and why might both of these instruments be used, and what's the role and benefit of each. And so Yunzhi did a great job presenting. Let me try to just highlight some of the key intuitions for the different pieces as they come together. Okay. Now, in the paper, and if we think about it, just more generally, short-term debt we know has a lot of advantages, right? It's constantly reset and repriced. We know it's going to mitigate against lots of agency costs, including the dilution cost that's relevant here. It's low risk, it tends to be low cost for those reasons. And so a question would be, if you have access to short-term debt, why are you going to issue long-term debt? And the answer in the paper that we'll see is there's going to potentially be a relative tax benefit associated with long-term versus short-term debt. That wasn't highlighted in the presentation, but it is in the paper. And there are risk-sharing potential benefits from long-term debt that will enhance debt capacity in certain states and delay default. And it's these two features that are explored, and nice intuition comes out from the paper. So that's going to be the motivation to issue long-term debt. Does the firm actually benefit, though, from issuing that long-term debt? And the answer is going to be no. And I'll talk about that as well. Okay. All right, so what's the model? It's a very standard model. Think about a firm, geometric Brownian motion, earnings, kind of standard, set up initially in some good state. We're going to call that the upturned state. That's the initial state that the firm is in. In the paper, they look at sort of volatility, also look at cases where the volatility is essentially zero. I won't really focus too much on that here, but consider just sort of standard geometric Brownian motion. And then we're going to add into that taxes at some rate pi. The presentation kept that at 0. I'm going to include that in my discussion here, and that's also important in the paper. And then in terms of discount rates, we're going to assume that creditors discount cash flows at a lower rate than equity holders do. And so these two things are going to give a motivation for why we want to issue debt, right? We want tax benefits from debt, and also debt holders just charge less. And then, of course, on the flip side, there's some default cost. We're going to make that extreme here 100%, and so now we have the usual ingredients we need for a trade-off theory of capital structure. Again, the default cost assumption is extreme. That's not crucial, but that simplifies things in the paper. Okay, what else can happen to the firm besides these geometric Brownian motion shocks? Well, there's an arrival of a downturn, right? So there's some arrival rate lambda of a downturn. What does that do? It decreases the growth rate of the firm. In some specifications, that might be a very negative shock, but the firm's still alive. It's still going in this downturn state. And it continues in that downturn state until we reach the game over state. There's some arrival, once we're in the downturn, of just everything shuts down and game's over. Okay, so what's really going to matter, of course, for us are these two, the upturn, what happens initially in the upturn state, and how do things behave in the downturn state. All right, so that's what we're going to try to track here. Now, what are the instruments that we have? We have debt issuance of two types of debt. We have short-term debt D, we have long-term debt F. That's the face value of the long-term debt. How do they differ? Short-term debt is instantaneous maturity. So think of this as one period, DT period debt, but where we've taken DT to 0, right? So it's truly instantaneous. And what that means is that any new issuance occurs after the existing short-term debt matures. Long-term debt is sort of anything else, anything with any positive maturity. We're going to model that as amortizing over time. Average maturity 1 over the amortization rate. The important thing is here, new issuance can occur before the existing debt is fully paid off. Okay? And that's going to be the key difference. And what that is going to mean is that there's going to be no dilution or debt ratchet effect associated with this instantaneous short-term debt. There will be with this longer-term debt. And when we look at the short-term debt, it's going to be only exposed to jumps that lead to immediate default. And so it's always going to be priced at 1, and the yield will reflect what's the instantaneous likelihood, what's the hazard rate of a jump happening that could lead to default. Long-term debt is going to create, in fact, a risk of endogenous or gradual default. And the pricing, as we'll talk about in a moment, of that is going to be priced equal to, in equilibrium, the marginal cost to the issuer. Okay. All right, so let's think about what happens. Let's first think about a world where there's only short-term debt. That's the only choice, if we only have short-term debt. Because the firm renews every instant with zero leverage, it's like we're starting from scratch at each point in time. So shareholders are going to choose short-term debt to maximize that joint surplus, as was mentioned in the presentation. Right? If we're starting from 0, we want to maximize the joint surplus between the two. Okay. Now, if I were to set the short-term debt to be some fraction less than 1 of the total surplus that's available, then the no default condition is going to be when I arrive to the next period, the total surplus available has to be at least enough to pay off the existing debt. And if that was set to be some fraction of the previous value, then you can see if I let dt go to 0, that's never going to be a problem for Brownian shocks, right? Brownian shocks are never going to lead to default as long as alpha is less than 1. In other words, I can push leverage all the way essentially to 100% if I'm just worried about Brownian shocks. Okay? And so that's exactly what's going to happen. In the downturn, because the next big shock is just game over, and we don't care about anything after that, we're going to push leverage all the way to 100%. Short-term debt's going to be equal to that entire surplus. So we're going to have 100% leverage in the downturn. And what about in the upturn? Well, in the upturn, we have a choice. We can either go to 100% leverage in the upturn, but then immediately default when a downturn hits, or we can go part way and say, let's just have enough debt so that we can survive when a downturn arrives. We'll go to the maximum we would have in a downturn so that when the downturn hits, we'll still survive. And there's going to be a trade-off, obviously, to doing that. And essentially, the benefit of going all the way to 100% leverage is we basically get lower cost of capital on a larger amount of debt. We get some tax shields on the risk premium that we end up paying on the short-term debt, but we are going to lose the firm if there's a downturn. And so we're going to trade those off, and depending on that, we'll either pick one or the other. Okay, so that's what would happen with only short-term debt. Okay, what about if we just have long-term debt? If we just have long-term debt, we know there's a smooth Markov perfect equilibrium. What is the debt issuance rate going to be in that smooth equilibrium? It's going to be basically the numerator here is the gains from trade, right? That's that lower cost of capital on the debt that we're issuing, plus the tax shields from the coupon. Pi is the tax rate, R is the coupon rate. And that's going to be normalized by the price impact of our trade in the long-term debt market, and that's going to determine the rate of issuance. This is a standard sort of monopolist issuance problem. Okay. Now, what this means is that with long-term debt, we're always issuing, right? The numerator is always positive in that expression. We're always issuing. That's that ratchet effect. That doesn't mean we go to 100% leverage, though, because that's offset by debt maturity, and it's offset by asset growth. And what we'll get is a slowly mean reverting process for leverage in this long-term debt, in the case of long-term debt. Okay. Now, let me try to, one question though is how is this pricing determined? And let me try to give just the very brief intuition for what goes on here. We can think of this like a durable goods monopoly problem. And if you remember standard sort of coast durable goods monopoly, if you think about marginal cost and demand, the problem is, of course, the monopolist wants to not go all the way to the competitive solution, but we know that, ex post, they're going to keep issuing. And if consumers are rational, they expect this. And so what happens is the demand function, the effective demand function, flattens out. Because if I know you're going to lower the price in the future, I'm going to wait for that today. And so we're going to jump immediately to the competitive outcome. Okay, that's sort of standard durable goods monopoly. This has similar dynamics. It's a bit different, though. And the key difference here is that the marginal cost curve is decreasing, right? The more debt I have outstanding, the cheaper it is to issue more debt because it's riskier, right? And so with a downward sloping marginal cost, what happens, same sort of dynamics, but we can't go all the way to this point. That wouldn't make sense because no one would issue. You'd lose money. What happens is the demand curve in equilibrium gets pushed down to just right on top of that marginal cost curve, right? And we're going to slowly walk our way down towards that competitive point, if you will. So price is going to equal marginal cost, and there's going to be no gain from trade in this case, all right? And so that's kind of the quick intuition of what's going on in this model with just long-term debt. All right, so now let's put them together, and short and long-term debt. So what's going to happen? So first in the downturn, right? So that's what's going on there. We know that whatever the long-term debt is, the short-term debt is going to go to 100% leverage, right? 100% leverage. What's going to be the incentive to potentially issue long-term debt in this model? Well, it turns out that there may be, for tax reasons, that there's a potential relative tax inefficiency of long-term debt. And that's going to depend upon whether the coupon rate R exceeds the yield on the long-term debt times the price, the yield on the short-term debt times the price of the long-term debt. So let me explain what's going on here. If I issue another $1 of long-term debt, I get a tax shield based on the coupon of R. But I have to reduce the short-term debt, right? Because the short-term debt is going to be set to just whatever the remaining surplus is available to get to 100% leverage. How much do I have to reduce it by? Well, going back to this equation, if I increase F, I've got to decrease D by J prime, but that's marginal cost of long-term debt. That's equal to the price of long-term debt. Price equals marginal cost. And so that's going to be the condition. That's how much short-term debt I have to reduce if I increase $1 of long-term debt. Now just rearrange this in your head. If I divide by the price of long-term debt, what this is saying is the current yield, there's going to be a relative tax advantage if the current yield of long-term debt exceeds the yield on the short-term debt, right? R over P is the current yield of the long-term debt. And in that case, long-term debt is just going to be a cheaper way, a better way to buy tax shields if I'm interested. And so there might be some motive to issue long-term debt even in this scenario. Okay. Now, what it also means, though, it's going to be most attractive to issue long-term debt for tax reasons when long-term debt's already high. And so when long-term debt's high, it becomes even more attractive to issue. When we don't have much, it's going to be safer, it's going to have a higher price, it's going to be less attractive to issue. And that's an interesting dynamic that I think could be explored more in the paper. All right, what happens in the upturn? This is the initial state. This is the main state of emphasis in the paper. The same relative tax efficiency stuff applies, so I'll just leave that aside. There's another motive as well to potentially use long-term debt, and that is the hedging of a downturn. Okay? So in the world where we've chosen not to issue so much short-term debt that we're going to immediately default when the downturn comes, if we're going to survive the downturn, then there's a motive to issue long-term debt. So what is that coming from? And let me try to explain this equation. It's coming from the fact that I'm going to gain debt capacity by issuing long-term debt. Why? Because I can, when I issue $1 of long-term debt, I get the price pH for that long-term debt. That because I'm currently in the high state, I'm in the upturn state, and I have to sacrifice short-term debt. But remember, from what we calculated before, the short-term debt's set to be the max I can have in the low state, and so the amount of short-term debt I have to give up is given by PL, same thing we had over here. And so that difference, pH versus PL, means that I can have relatively more long-term debt and cut back a little bit less of short-term debt. And so I'm going to actually gain borrowing capacity. I'm going to gain debt capacity. And since creditors are offering me that debt at a low price, because of that difference in discount rates, gaining debt capacity is a good thing, right? And so that's another way to think about what's going on here. And you can think about it as sort of hedging as well. And the paper does a nice job of showing if we had available instruments that we could use to hedge, that would be another way to achieve this, and then we wouldn't need the long-term debt. We could just have more short-term debt and use those hedging instruments as an alternative. Okay, so let me just quickly try to wrap up. If we look at what does this all mean for firm value, it turns out that the short-term debt-only equilibrium is actually the best for value in this case, and that's because with continuous trade, the gains from any long-term debt are fully dissipated. Remember that picture I showed you before? And so there's, the firm's going to use it, but it's not actually going to benefit from it. All right. Finally, let me just give some concluding thoughts. Both types of debt are highly stylized, right? That's necessary for tractability. We have this extreme of short-term debt that's instantaneous. We're looking at, the full dilution problem with the long-term debt. Which is closer to reality? That's a good question. We can think about, though, do typical capital structures look more like a cliff where we reset to zero leverage and then kind of start over on a periodic basis? Or is it more of a ladder structure where there's this sort of overlapping? And I think that is useful to think about as we get into more nuances of capital structure and their dynamics. If we think about trading frictions in this setting, trading frictions are going to be a big problem for short-term. This instantaneous debt's going to be very fragile. If there's a small cost to rolling this debt over, you really don't want to do it instantaneously. That's going to be a big problem, and that's going to kind of collapse its value pretty quickly. On the other hand, long-term debt's going to benefit from trading frictions. Remember, the whole problem with long-term debt is because I can issue it whenever I want, that's why the gains are going away. If we add any small frictions there, we actually will capture gains from issuing that long-term debt. I think of the model with Zhigo as sort of looking at the extreme for tractability to understand the dynamics, but of course, in reality, we're not at that extreme. We are capturing some benefits from that long-term debt. They're just limited. And then finally, if we think about reputation in this context, there's a nice paper by Andre and Malenko and Tsoi, 2020, which says that in that case, we may be able to get some of the commitment benefits of short-term debt even with long-term debt by looking at non-Markov equilibria, where if the firm's past behavior, in addition to fundamentals, impact the price it's going to pay. And so that can be interesting as well. All right, thank you.